Advanced Financial Accounting. In this presentation, we're going to work a consolidation problem within Excel. This problem for a non-wholly owned subsidiary. So we have one company owning another company. It's not a fully owned subsidiary at the time of purchase, so there was no goodwill that resulted at that point in time. We're going to say it is now at the end of year 2. So we had 1 year, full year passed. The purchase took place in January. We had one entire year. Then the second entire year took place. Now we're going to be performing the consolidation at the end of that second year. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We have our information on the left-hand side. We're going to enter that information into the blue area on the right side and below, including the journal entry as well as our worksheet. And then we'll put this stuff into financial statements, balance sheet, income statement, statement of retained earnings. Let's take a look at the data on the left-hand side. We have P purchases 80% of S outstanding common stock. So P is going to be the purchaser, S is going to be the subsidiary. I'll typically be talking in the mind frame of P. So we're like P and we're the purchaser of S, 80%, not a full purchase. We're not getting 100%, but we have a controlling interest. And the purchase happened on January 1st, the beginning of the year, so we have a full year happening. However, it's 2 years later now. So 2 years ago, year 0, you can think of it, and then 2 full years later, so the end of 2x2, we're going to say is the date that we will be consolidating. So, and then the purchase was for $300,000 for that 80% interest when the book value of S, meaning assets minus liabilities, not the assets minus liabilities now, 2 years later, but if you were to do that as of the point in time of purchase, the assets minus the liabilities of S would be the 375, and we purchased 300,000, which happens to be 80% of basically the book value. So we purchased it at book value, as we'll see shortly. P uses the equity method to account for S. Therefore, on P's separate books, we have the investment in S done on an equity basis method. Then we have S accumulated depreciation here. So for our accumulation adjustment, that was at the beginning. And then we've got the end of the second year. So remember, our goal is to think about this. Now it's 2 years later since the consolidation date. Then we're going to do our little calculation down below. So the book value at purchase S, the book value at purchase for S is what we're trying to say there, times 80%, our 80% interest means that we got the book value times the 80%, and that's going to give us the 300,000. So in other words, at the time of purchase, book value S, 375, 80% of that, 300,000. Therefore, we purchased basically our 80% portion of the book value. So if we were to compare that to what we spent, the 300,000, there's no goodwill then at the point in time of purchase. That's going to be a simplification than what happens typically in real life, where those two numbers aren't always the same, but it's useful to see them in that format, add levels of complexity as we go. That means if we were to take the book value and compare it to the non-controlling interest, which if the controlling interest is 80% would be 20%. So if we take the 20% then, book value at the time of purchase 2 years ago times the 20% would give us the 75,000, 300,000 plus the 75,000. Then of course would be the total interest at the point of purchase, or net assets or equity section of S, the company purchased, the 375. All right. So then we have our worksheet over here. We have same kind of scenario we have seen in the past. We're going to say, hey, give us the books for P and S. Give us their trial balance. We're going to line them up side by side. Typically, they won't line up as cleanly as this. We'll have to work those accounts together so we can have the proper grouping and align them together once done, however. Then we can sum up over here and say, let's get our consolidated numbers for company P and company S. Let's do that now. So I'm just going to sum up the totals. If we have 2 columns that are in balance and we were to add them up and sum them down, I'm just going to copy and paste the formulae all the way down. Then we should end up with something that's going to be in balance, changing that red number to a green number. So here's our consolidated numbers at this point in time. Then we need to be doing our elimination entries. So we're going to do the elimination entries, very similar to the last problem we did, except now we're not talking about the end of the first year, but the end of the second year at this point in time. The investment's still on the books at an equity method. So what that means then is that the journal entries that are affecting that account, we don't have the first year, right? Because it's been 2 years now. So they purchased it. When they purchased it at the book value for the $300,000. That was last year. This year, the only thing that happened was they increased the investment P did for their interest in the net income of S. In other words, S earned $94,500, and P recorded their portion, or 80% of it, at $75,600. That increased not the inventory, that increased the investment in S. Sorry about that, picked up the wrong account with inventory. Increased the investment in S, and then it increased the income, which you can see right here. So that's where those two numbers come from. And then, or that's part of what's been included in them. We're not going to recalculate the whole thing because, again, you can't see the first year because we're in the second year now. And then what happened is they gave a dividend of the $36,000, and we took our portion of the dividend, which, if we're thinking of ourselves as P, which is 80% of that 36, which is the 0.80% of it, and then that would have decreased the investment account up top because we're using the equity method. So those are normal equity method techniques. Now, knowing that, we're going to go through the same process we had before, very similar kind of journal entry we had in the last problem for the second year here. So we're going to say, all right, the investment needs to go off the books. I know that. That much I know. I'm just going to build this as I go. I'm not going to worry about putting debits on top. I'm going to do this as it makes the most sense to me. Both so it helps me to create the journal entry, and so when I go back to it, it doesn't look pretty. It looks how I know it makes sense to me. And then I'm going to say, all right, what's the other side of things that happen there? We're going to be removing basically S's common stock. So we're going to remove the common stock. Now the common stock and basically the equity section, the entire equity section for S, the common stock would be the same amount typically from when we had the consolidation 2 years ago if they had a par value and they didn't issue any more common stock. So that would be what it is. So I'm going to be picking up, all right, the common stock. That needs to go, I'm going to take that off the books for S. So I'm going to remove the 183. Now the retained earnings would not be the same as of the date that it was purchased. However, we're going to remove the entire, retained earnings as if it was wholly owned, basically. And then we're going to record our portion, or the non-controlling interest portion, not our portion, the non-controlling interest portion separately. So that means we're basically going to remove the entire S's equity section. So we're going to remove that, make that go down to 0. We're going to do the same for the dividends because, again, it's kind of part of equity. It would be in retained earnings. So we're going to remove it entirely and then record it included, as part of the equity section down here, the non-controlling interest equity section. So that has a debit, so we're going to credit that. So there we have those items. Then we have the income statement, and down here we have the $94,500 on the income statement, and we want to see these numbers right here, right? And we've doubled that up by recording the net income, our portion, the 75% over here. So this item needs to go off the books. The 75.6 needs to go off the books. So we're going to say, all right, that needs to go. I know that's got to go away. We can't have income from ourselves to ourselves, and we want to be showing the income not as one line item in our consolidated statement, but in the proper categorization. So I'm going to then remove that. So let's remove that. So that's the 75.6. What about the other 20% of income? The other 20% of income that's included here that didn't get picked up here, the non-controlling interest. Well, we're going to put that in our new account down here, the non-controlling interest. So I'm going to say, all right, now the non-controlling interest is going to be equal to the non-controlling interest in the income. And that's going to be equal to the net income of, I'm going to say negative of the net income of S times the non-controlling percentage, 80%, times 0.8. So there we have it. Actually, that's not right. That's the controlling interest. The non-controlling interest is 0.2. The controlling interest is 0.8. 100% minus the 8%, 80% would be 0.2 or 20%. All right, so there's the non-controlling interest. Now we're going to be picking up the non-controlling interest on the equity side of things, the non-controlling net assets side of things. So we're going to say, all right, let's hit that one. That's going to be this account. And you can think of that as basically the plug now. If everything else is correct, this should be the plug. So this is one way you can think of it. You could say, all right, well, that's just going to be the negative sum of this entire thing. That's going to be the negative sum of this entire thing. And there's the 77.9. The other way we could think of it is like, well, okay, since we purchased it at our 80% book value exactly, given our assumptions, assets minus liabilities equals the equity of the 389.5. If we pull out the trusty calculator, make it a little bit smaller. If you could, calculator, be a little bit smaller than that. And we say the 389.5 times the let's say 0.2, 20%, is the 77.9. Or in other words, if we took all equity, meaning all the blue accounts, including the income statement, that's the same, 389.5. So if we took the equity, the 389.5 times the 0.2, once again, the 77.9, same calculation there. Just two ways to get to the equity section. So there we have that. There's our main journal entry. Very similar for this one in the year one that we did. Now we're just going to do that last journal entry to get rid of the depreciation, which we've given over here. This is what the accumulated depreciation was at the point of purchase. So we're going to put the S's property, plant, and equipment in essence on the books as of book value at the point of purchase, and remove the accumulated depreciation at that point in time, then record accumulated depreciation going forward. That means we're going to do as we've seen in the past. So I'm not going to do that. I'm not going to spend a whole lot of time explaining it. I'm just going to do this again. And we're going to be pulling this number from the 10,000. Now we can't really calculate it from the text like we kind of did in the little tricky situations in year one, because now we're in year two, but we would know what it was from the point of consolidation, the journal entry at that point. So there is that. We're going to record this out. So let's see what this will look like then. We got the investment in S. We know that needs to go away. So the investment in S is going to be in, let's move over a little bit. Here we are in L6 equals the investment, and that's going to make it go down to 0. So it goes down to 0. Then we have the common stock. So I'm going to go down and say, all right, common stock is here. We're in L12. I'm going to say equals and scroll back on up to that 183,000. And there it goes down. So there's P's amount. This is S's amount. There's the total. Then we removed S's amount back to P's amount. Then we're going to record the retained earnings. Retained earnings here in L13 equals. We're going to be picking up that 148. So once again, here's P's amount. Here's S's amount. There's the total. We removed P's amount back to S's amount. Then we're going to be recording the dividends. So here's the dividends here. Equals, we're going to be saying there's the 36. Same story. Here's P's, here's S, there's the total. We removed S, then back to where we were with P. Then we have the income, so that has to go away. So here's the income that needs to go away because it's income from ourselves, income from the subsidiary. So we will be picking that up. And so that goes down to 0, so that looks good. Then we've got the non-controlling interest in net income. So non-controlling interest in net income basically acting as an expense down here. We are in L21. L21 equals, and scrolling back up, we're going to be picking up that 19 or that 18.9. There's the 18.9. So there we have that. And then finally, we have the non-controlling interest in the net assets. Non-controlling interest in the net assets. And that's going to be in L15. So we'll scroll back up and pick up that 77.9. And there we have that. So that should put us in balance. So that looks good. That looks good. And then we're going to record the last one, which is the accumulated depreciation. That's going to be here. And we're going to be picking that up. So that's going to decrease the contra account. And then we're going to be putting that into the building and machinery. And so that's going to be decreasing. What that does is, once again, if you were to look at these two numbers for S as of the book value statement, this bottom number accumulated would have been 10,000, and we're recording it on the books at the net amount in the PP&E account as of that point in time, in essence. All right, now let's take these numbers and let's build our financial statements just to get an idea. We're going to do this really quickly, but just to get an idea of how this would look. And we're really only looking at those, concentrating on those differences, which is going to be this account and the equity account. So we were just going to throw this into a balance sheet and income statement just really quickly. We're going to say, all right, let's go and say the assets are going to be cash. So we got cash is there. Let's go ahead and pick up the right number first. And then I think we could just copy and paste this down. So I'm going to Control C and paste this down, right on down. Control V. I'm going to get rid of this account because that shouldn't be there. So we should probably delete the whole thing. But example problem, so we'll not. Then I'm going to sum this up in the outer column. So there we have that. Looks good. And enter. Then I'm going to put a little underline under this one. Let's put a home tab font group and underline that one. Then we're going to go down to the liabilities. Let's put an indentation here. Home tab, alignment, and indent. Going to put this in the liabilities. There are credits here. I want a positive number, so I'm going to say not negative, not equals, but negative of that number. And then I'm just going to Control C, scroll down, Control V, and then I'm going to be in the outer column equals the SUM, Control 9 or Shift 9, up arrow, Shift, holding down Shift, up, and then Shift 0 to close it up, and enter. So there we have that. And then the equity, this is where new stuff happens. New stuff happens down here, so we're going to be in the equity. Once again, there are credits up top, so I'm going to change the sign by saying rather than equals, negative of that 490. The retained earnings is basically going to be all of this stuff excluding the dividends. So there's a couple ways we can do that. I can say, okay, retained earnings, I'm just going to say is the negative sum, kind of like our plug formula. I'm just scrolling over using the arrows, which are just going slowly. Computer's slowing down here. Got stuff going on. I got music in the background. I can't handle it. I'm holding down Shift and then just scrolling all the way down. And then close that thing up and enter. Now I'm going to pull out one little portion of it. This is the new thing, the non-controlling interest. So the non-controlling interest, I'm going to say, is that amount. And we already included that in retained earnings. So what I'm going to go is I'm going to go back into retained earnings, go to the end of it, and just say minus this amount. Or in other words, retained earnings is going to include the retained earnings here. And it's going to include this, minus this, holding down Control, plus this, minus this. So let's do that one more time. We got this, holding down Control, and this. Excluding the 77.9, that gets us to the 699.6, which isn't what this number is, because I picked up the wrong number here. This should actually be negative of this number. So sorry about that. So then we've got the 77.9. So let's try this again. So the retained earnings then should be this, holding down Control, and these for the 6996. And there's the 6996. We calculated it here as this entire thing minus this amount that we pulled out, which is the 779. Okay. So then we're going to sum that up and say sum. Let's see if this works. Let's see if we're in balance here. If I mess something else up, which is quite possible. But that's why we have the double entry accounting system. It helps me to, find when I mess things up and then fix them, hopefully. Sum, and I'm just picking up the equity and the liabilities up top. So there we have that. Okay, so there's the 1,582,000, the 1,582,000. That looks good. At least it's in balance. That's a good sign. Now I'm going to hide from O to R. I'm going to hide these columns and we'll take a look at the income statement. So I'm going to put my cursor on O, left click, I'm going to go over to R. So we're selecting the OR range, or right click on the OR range, and then we're going to hide that range. Let's do the income statement now. So I'm going to start in the outer column over here. We're going to go to the outer column. I'm going to say negative. We're going to pick up this item. I'm flipping the sign. That's why I said negative instead of just equals. Then we'll pick up the cost of goods sold is going to be equal to, and let's see what we have here. Cost of goods sold is going to be this number. Then the depreciation is going to be this number. And then the other expenses is going to be this number. And then we're going to break out this non-controlling interest separately. So I'm going to say enter. And then I'm going to do a little subtotal here before we break out that last component. So I'm going to say this equals the sum of all the expenses except that funny new expense that we put in there. And that's going to be this amount. And then if we subtract this out, we're going to say sales or revenue minus the expenses. That's the 289.5 consolidated net income. Now we're going to treat that non-controlling interest kind of like an expense. And we're going to decrease this amount more by that non-controlling interest. So I'm going to say equals less the non-controlling interest of the 18.9, which, like I said, is kind of acting like an expense on our trial balance over there and here on our income statement in essence. So then I'm going to say, should actually be down here. I'm going to say down here, the bottom line is going to be then the consolidated net income minus or less the net controlling interest, a non-controlling interest. I'm going to put an underline on this. And so there we have it. So this 27600 should match basically our bottom line number on our trial balance here, which is including that new account that we have. All right, and then let's take a look at the equity section. So the equity, the retained earnings calculation. I'm going to recalculate retained earnings here. So we'll say the beginning retained earnings was this. It's what's on the trial balance before we close everything out into it. And then we've got the number, basically kind of like our net income number, the consolidated net income to controlling interest. And that's going to be the 270,600 less the dividends. So we'll pick up the dividends. I'll put them in there as a negative so we could just sum it up. And that should equal our ending balance for retained earnings. So if we sum that up, ending balance, which is the 6996 that you'll recall we calculated as this, and then all of this. So the 966,600. Now let's go ahead and unhide the balance sheet and just double check our numbers here. We're going to go from M to S. So I'm going to highlight from M to S, right click on the selected area and unhide. And then let's just double check. We've got, all right, so our assets equal the liabilities plus the equity. We've got our retained earnings here matching out to our retained earnings there. And the bottom line on the income statement matching out here. So that looks like we're basically tying out. So notice that, you know, the newer things here, of course, are the income statement, this new line item, kind of like you see, kind of like acting like an expense, and then breaking out the equity section for the non-controlling interest here in the equity section.